Well, good morning. Welcome back to the broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Thursday, September 16th, 2021. And our top story today, target date funds, what you need to know. And joining me now to discuss this and a lot more is Bailey McCann. She's a journalist and Wall Street Journal contributor. Bailey, it's great to see you. Thanks so much for joining us on the program this morning.
Thanks for having me.
Yeah, and we're really going to focus on target date funds today. You read a great piece for the Wall Street Journal. These funds cover over 40 million Americans and close to $2 trillion based on the article. What do we need to know about them?
Well, they are the default choice for a lot of investors who get into their company's 401k. And, if you're a low information investor, somebody who just signs up for all the defaults, you may not know that's what you're in, but they are basically designed to work for those people specifically and create kind of a set it and forget it portfolio that can deliver them to retirement.
And really, I think the proliferation of these funds was around the Pension Protection Act. We think all the way back to 2006. I know it's like such a long time ago, 15 years ago. These really led to the growth, I think, that we've seen over the last decade and a half.
For sure. Yeah, they've been very popular with investors.
Let's talk about kind of what people should be thinking about if they're investing in these funds, because they're sold kind of as a set it and forget it type of philosophy, but you really still have to be vigilant as an investor. You can't just push off your responsibilities. So you should probably know about fees and other aspects of the portfolio.
For sure. I mean, there's no free investment, right?
No, not at all.
So, there are fees associated with these. They're going to be a little bit higher than just off-the-shelf index funds that are ultra low cost, because they do come sort of pre-formed in a portfolio. You do get a measure of financial advice with them. So, that can also save you a little bit of money over the long term versus finding somebody on your own. And they do adjust over the life of the portfolio to sort of lead you to retirement and end out in a more conservative place. So during your prime earning years, that's also, your prime growth years. And then the closer that you get to retirement, those portfolios are going to get more conservative. And,
we'll talk about glide path in a minute, because I think you're kind of alluding to that. But let's talk about scrutiny. I think that's important. These have, because they've grown so much in assets, and I think that's great that people are saving. We want people to save, but we also want people to be mindful, and we want fiduciaries, people who have responsibility for these assets, to be mindful. Really, it's come to the attention of members of the House of Representatives and the U.S. Senate. They're taking a look at these products as well.
Yeah, and it's not for the first time. They looked right after the financial crisis, when these funds posted some pretty hefty losses. And what Congress is doing now is basically asking for an update to that look through and see if that is necessary, just because of, as you said, the amount of assets that are in these funds, and trying to make sure that they're doing what they say they're doing on the tin, right? So they want to make sure that people aren't surprised by maybe being in riskier positions than they expected at retirement, or they aren't surprised by fees, or if they get under the hood and look at what's in these funds, they aren't going to be surprised about what's in there and find, suddenly riskier investments. There was a change. The Department of Labor opened the door to possibly including private equity in some of these funds in the future. Nobody's pulled the trigger on that yet. There are some providers that say that it can be done. And, if that happens, then the fees are likely to go up. Private equity is typically more expensive than mutual funds, index funds, and less transparent, obviously, because we're talking about the private market. So those are going to raise some questions for Congress and also for fiduciaries to make sure that they're still sticking in line with their fiduciary requirements and their ERISA requirements.
Yeah, and I love that you brought that up, because, as the world is shifting from an asset management perspective, that you look at the pension funds and endowments, they have really shifted their strategy of investing to hedge funds, alternative investments, et cetera, direct real estate. And so it's not uncommon for fiduciaries to consider this. But Bailey, what's interesting is that with these target date funds, they're all basically composed of underlying funds, right? As you said in the article and you said here, when you swap out one of those funds, you don't necessarily need to communicate that you swapped out, for example, an S&P 500 index fund with an S&P 500 index ESG tracking fund, right?
Right.
Yeah.
Right.
So
yeah.
Go ahead. I'm sorry.
Oh, no, if you look at the disclosures around some of these funds, investors are told to expect a certain level of dynamic adjustment and rebalancing in response to market conditions or in response to things like ESG concerns. But, that could also potentially include the addition of private equity or the addition of allocations toward REITs or other asset classes that maybe aren't as straightforward for people as stocks and bonds.
Yeah, Bailey, I need to take a quick break. When we come back, we'll talk more about target date funds, and what you need to know. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking to Bailey McCann. She's a journalist and Wall Street Journal contributor. Bailey, thanks so much for staying with us this morning.
Sure.
Let's talk a little bit more about these target date funds, and let's talk about education, because again, just to kind of pick up what we were talking about in the first segment, it's that set it and forget it mentality. There's a lot of things that you, as a fiduciary who's picking investments for your plan, and also as an individual investor, that you need to be aware of. And I would think that education top of mind for a lot of these service providers and asset managers.
Yeah, definitely. There has been a bigger push, I will say, to including more information in general in a retirement portfolio for individual investors, and especially on online portals when they go to log in, giving some more fact sheets and different modules that people can go through to understand what's in there. And as I said before, with the target date funds, you get some measure of financial advice. So there is somebody, that you can call or send questions through to and get those responded back to you, which can be helpful for investors that are trying to understand.
Yeah, really important. I mean, you got to continue to do your due diligence. Let's shift gears and talk a little about some of these concepts like retirement income. Set it and forget it. Really important. Look, accumulation. If you don't have money to decumulate at retirement, that's a huge issue, and why we got the Pension Protection Act, auto enrollment, the growth of target date funds, right? But I want to get your sorry for the long-winded question. I'm getting to it, but I want to get what some of these manufacturers are doing. These fund manufacturers are doing in terms of the drawdown. Are you seeing interest in maybe annuities or annuity-like products?
So the decumulation phase, as you said, is a hot topic right now. I think there is a lot more attention being focused on how to help people make sure that they have consistent income throughout their retirement, specifically because of how longevity risk has come to the fore as a big issue. People are living longer. And so, if you started saving 20 or 30 years ago, when the formula was still, retire at 65 and everything is fine, you might be surprised to discover that requires a little bit more active planning. If your life expectancy is now 85, 90, 100 years, than it might have when you were having those conversations 20 or 30 years ago. So there is a lot of focus on things like annuities. There are a lot of costs that are associated with annuities, but there have been efforts to bring those costs down and to make the product itself more straightforward for investors, because that is an insurance contract, so it's going to be a little bit more complex than maybe some people expect right out of the gate. But I think there's a lot of room for innovation in terms of products that help investors with decumulation and with consistent income throughout the life of their retirement.
Yeah, and I think it's a great thing. I think I want to live as long as I can, and I want to have a quality of life in retirement. And retirement obviously means different things to different people. I may have a second, third, or fourth career. Who knows? I'm already on my second one. You may do so as well. You may be in a different field altogether. This retirement income piece, we saw in the Secure Act, we have now a safe harbor. So more plan sponsors, people who sponsor retirement plans, might consider annuity and annuity-like products within their program.
Yeah, for sure. And I think, you've also seen the annuity industry respond with some innovation on their own to try and make that easier to do and more accessible. So I think it's going to be an ongoing conversation in terms of being able to structure those products in a way that makes sense for a wider variety of investors and makes it easier for people to get into.
Yeah, here's one out of left field. It's kind of close to Bailey, it's kind of close to what we're talking about. Let's talk about fund structures, because a lot of people are used to the word mutual fund, and
sure.
That is a publicly traded, generally a publicly traded investment. But there has been a push around collective investment trusts, which are predominantly used in 401k plans and governmental 457 plans to further reduce costs. Are you seeing, for example, target date manufacturers consider moving to a CIT type structure?
Yes, that's been a huge trend. There's a significant effort underway because a lot of the strategies don't fundamentally, the underlying strategy doesn't usually fundamentally change. You can look at a mutual fund and a CIT that are offering the same strategy and use the mutual fund performance as a proxy for the CIT. And so there's a lot of overlap in how these two products work from a strategy perspective. The issue is that it's much cheaper to put target date funds, to put investors into the CIT. You have lower fees or different things in terms of how you can construct them to keep the overhead lower. And that, alongside the growth of ETFs, has been really foundational in toward moving the cost structure down for target date funds. And that's, obviously a benefit for investors.
Yeah, absolutely. The lower price, and if you can get the same return, I mean, that ultimately that's great, especially if it's the right glide path. Last question here, Bailey. Let's talk about managed accounts. And when I think of target date funds, very similar approach, not exactly the same. A managed account solution, they tend to use the underlying investments in the retirement plan to construct portfolios, and those portfolios a little bit more individualized. How does that compare, and what are you seeing in terms of those particular products versus life cycle or target date funds?
So it really is going to depend on who your plan sponsor is and what you're into as retirement. So, a lot of big public employer plans are going to be going towards target date because it's there are buckets. It's much clearer. There's less customization. You can reach a whole variety of your employees that way. More customized version, the managed account version, will work for some employers that maybe have unique needs. Maybe they want to achieve certain things for their employees. Maybe, they just want to have a little bit more customization than what they're finding in the target date universe. That's not necessarily a bad thing, but it is incumbent upon investors to get under the hood, understand what the costs are, understand what is actually in the managed account. And, you're probably going to have a different response rate than the target date financial advisor. You might have to work with somebody else that might take a little bit more legwork to get that information. But as long as you're comfortable with it, it can work out the same way as a target date fund or other retirement portfolio.
Yeah, I see. I just anecdotally interested in your. I lied. It wasn't the last question, but anecdotally, sorry about that, Bailey. But anecdotally, I mean, I think the service providers, those that provide these types of managed account services, look, record keeping, you don't make a lot of money on it anymore. The costs have gone down to single digits when it comes to basis points, percentage of assets. The opportunity for a lot of these companies is managed accounts. And I think you make a really good point. You really have to assess not only the fees, but the value that you are bringing. Because it's never just about fees, right? Litigation isn't just about fees. It's about the value that you're bringing to consumers, to the employees.
For sure. And a lot of that has to do with risk profiles. There have been a lot of employee groups that are ultimately uncomfortable with where the risk ends out in a portfolio, especially off the heels of a down year, or if there's some kind of significant correction in a specific asset class. And, that can be difficult for people to understand who aren't enmeshed in money management every day, where what seems okay for money managers could seem possibly less okay for an individual investor to get their mind around. And so you have to really, as the investor, get engaged, have those conversations, make sure that you're comfortable with what's in there. And if you're not, talk to your employer or work out some other plan for yourself that makes you more comfortable.
Really good last thoughts there, Bailey. Bailey McCann, always a pleasure chatting with you. Really enjoyed the article, some really good points, and we look forward to having you back on the program again very soon.
Thank you.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.